Good morning, everyone, and welcome to our DAT IQ Weekly Market Update. This is our update for August 23rd, 2022. I'm Ken Animo, Chief of Analytics here at DAT.
And I'm Chris Kappas, Chief Scientist here at DAT.
Yeah, and I'm Dean Croak, Principal Analyst at DAT.
And this isn't some fancy editing. We're actually all live in person in the same location. We're coming to you live from our glorious Denver headquarters here. It's all brand spanking new. We wanted to take the opportunity, since we're all together this week, to do the show live.
It's rare. This is probably the fourth time we've all been together.
Yeah.
Physically.
So a lot of interesting stuff to talk about. Since we are, this is a little bit of a special show this week, we didn't really prepare any canned questions for the end of the show. We really want to rely on you to submit your questions. So go ahead and get them in early, especially if you have anything shipper related. We have the shipper guru sitting on my left here, and we will get to those at the end of the show. But to save time for those questions, I'm going to dive right into our key points of the week. So dry van rates and reefer rates are sort of passing through. You'll be able to see it in Dean's charts, 2020 levels. Still elevated over where they were in this time in 2018, which is good. We've seen some relief on the fuel side, all of which beneficial to our carrier base. New contract entering the rounding guide. Chris will talk more about this in a bit. Coming down a bit, again, pretty much exactly what you'd expect given the current spot environment. Used truck prices, really interesting data here. I'm sure Dean's going to dive into, but used truck prices are coming down. There's been a little bit of an insulating factor with the low mileage models, which I think is interesting to take a peek at, and it's very indicative of where we see capacity heading. Cash shipments relatively flat, and retail sales, according to MSU, up 0.3% year over year, and 6.5%. Over that 3-year average. So with that, I will turn it over to Dean for the market update. Dean?
Yeah, thank you, Ken. We'll start off with our load to truck ratio and dry van. Load post volumes are down slightly last week by about 2%. Capacity increased. Load equipment posts are up about 2% week over week. Volumes on the load post side are about 41% lower year over year. Interestingly, this was the first month since May 2020 where load post volumes have been consistently over a 4-week period below 1 million weekly load posts. Load to truck ratio ended last week pretty flat at 3.28. In the refrigerated sector, load post volumes are almost identical to 2017 and 2018 levels, but about half of volumes recorded this time last year. Volumes were down about 6% last week. On the other side of the ledger, equipment posts are at their highest level recorded in the month of August, including about 10% above the 2019 levels. Of course, you'll all remember that as being an oversupplied truckload market from a capacity perspective. Load to truck ratio in refrigerated was down to 6.0 last week. And in flatbed, load post volumes, as you can see from the chart, the load to truck ratio is tracking very closely with a number of our prior years. Load post volumes as a subset of the load to truck ratio are tracking closely with 2018 levels. They were up about 2% last week. That's the first increase in flatbed load post volumes in the previous 5 weeks. Volumes are still 52% lower than last year after dropping about 25% in the last month. Carrier equipment posts, though, they remain at all-time high levels and even 3% higher than the prior record high set in 2019. Load to truck ratio in flatbed dropped to 13.89 last week. Having a look at our market condition index, we're taking a look at the West Coast, looking at inbound and outbound volumes. West Coast continues to cool. Inbound load post volumes to the entire West Coast, I think it's about 9 or 10 markets, down 12% month over month. In Oakland, of course, where they've had a lot of recent labour strikes at the ports, inbound volumes are down 8% month over month. A lot of that is tied to declining exports. Oakland's one of the big export markets for freight. Inbound volumes into Los Angeles even down 7% in the last month. In both markets, San Francisco and Los Angeles, outbound volumes are also down 12% and 16% month over month. Having a look at a couple of high volume lanes, Los Angeles to Stockton is a high volume lane for Asian retail imports. They're at their lowest level in 12 months at $3.13 per mile. Remember, these are line haul rates excluding fuel. Loads east to the large Phoenix warehouse market followed the same trend at $3.18 a mile. And on the high volume intermodal lane between Los Angeles and Chicago, spot rates continue to increase and at $1.91 per mile this week are still 20 cents per mile higher than the July average, but 88 cents per mile lower than this time last year. In the refrigerated market, produce season in northern latitudes is starting to ramp up. Onion and potato growers in the Pacific Northwest have started shipping this week already. Idaho and Washington, good volumes coming out of there, even though the overall produce volumes are down about 9% so far year over year. The season is really just getting underway. Reefer rates for all outbound loads of apples, cherries and peaches averaging about $3.34 per mile last week. That's about 25 cents per mile higher than the same week last year. Spot rates from Yakima Valley to Los Angeles at $1.57 are 41 cents per mile higher than last month. But they typically increase between now and December, along with shipping volumes, which peak typically late November, early December out of the Pacific Northwest. Having a look at some of the longer haul lanes, Yakima Valley to Atlanta, 2,500 miles. Rates were flat last week at $1.85. That's up 20 cents a mile to Philadelphia. And to the large produce market in Hunts Point in the Brooklyn market, New York, rates were up 7 cents a mile. Having a look at the other big produce market that's coming on right now is Michigan. Volumes are starting to ramp up, but even though volumes are down 15% year over year, again, the peak shipping season in Michigan doesn't really start to ramp up until later in September. Looking at one of the high volume lanes from Saginaw, Michigan to Brooklyn, the Hunts Point market averaged $3.66 per mile last week. That's around 45 cents per mile lower than this time last year, but 65 cents a mile higher than the June average. So rates are starting to increase along with produce volumes there. And having a look at the flatbed market, higher import volumes into Houston continue to drive freight volume into the truckload market, although brokers and shippers found sufficient capacity on major lanes last week. One of the major lanes out of Houston, typically number one every week in flatbed, is Fort Worth. Spot rates averaged $3.52 per mile last week. That's 20 cents per mile lower than this time last month, but about 25 cents per mile higher than the same week last year. The number two lane out of Houston is El Paso in Texas. Rates dropped to $3.25 last week, almost the same as this time last year, and down about 50 cents per mile since June. So volume's really cooling off on that number two lane. Having a look at the largest steel production market in the country in Gary, Indiana, flatbed rates dropped to $2.03 per mile last week. Loads to Pittsburgh were down to the lowest level in 12 months. And almost double the rate they were about 4 months ago. In Baltimore, which is the largest port for roll-on, roll-off imports of machinery, spot rates have been steadily decreasing since the March peak in machinery imports, dropping by just over $1 a mile to $2.07 for outbound loads to Chicago. Baltimore to Davenport, home to some of the biggest machinery manufacturers in the country, rates have increased by 30 cents per mile to an average of $2.55 in the last few weeks. And having a look at our year-over-year spot rate charts, dry van line haul rates decreased by over 30% since the start of the year. Rates were down 2 cents per mile last week. The national average ended the week at $1.93 per mile. That's about 48 cents per mile lower than this time last year. Compared to our top 50 lanes, it's about 38 cents per mile lower. Top 50 lanes by volume of loads moved averaged 231 last week. Dry van line haul rates are still 32 cents per mile higher than the average of pre-pandemic years. And in refrigerated, following 3 weeks of successive gains, the refrigerated line haul spot rate dropped 2 cents a mile last week to a national average of 224. At that level, spot rates are still 55 cents per mile lower than the same week last year, and now 2 cents per mile lower than where they were in 2020. For context, reefer line haul rates, excluding fuel, are still 32 cents per mile higher than the pre-pandemic average for this time of the year. And wrapping up with flatbed, for the third week in succession, flatbed line haul rates have dropped by 4 cents a mile. The national average flatbed rate, excluding fuel, ended last week at 234. That's 33 cents per mile lower year over year, but still 5 cents per mile higher than the hot 2018 flatbed market. Still about 38 cents per mile higher than the average for pre-pandemic years. So that's it for this week's market update. If you'd like to find out more about what's happening in freight, go to dat.com/market update and download our weekly report, which will be uploaded tonight. And with that, it's over to Ken for the short-term forecasts.
All right, we got some spice on the forecast this week, and it gets progressively spicier as we move on. So just to refresh everyone's memory, we got the blue line, which is our historical rate. It's a 7-day weighted moving average, excluding fuel, for long haul only. And then you have 4 forecast models. You have in green our flagship ratecast model, in red is our short-term weighted model, and then you have 2 blended models, which take the first 2 and blend them in different proportions and degrees. So starting with dry van, what's interesting, I'm going to start with the red, which is the short-term model first. That little hitch you see there is Labor Day. And so it's anticipating that little bump and then coming back down heading into Labor Day. But the flagship raycast model is a bit optimistic here, at least more than the other three. So this is the first time in a couple weeks, right, that we've seen any sort of model disagreement here, especially short term. And that's starting to widen as we get into the tail half of September, right? So by the end of September, you're looking at, again, these aren't huge absolute differences, but you're looking at, maybe as much as 10-cent difference between the two models for drive-in. Moving on to reefer next. Again, all the colors are exactly the same. They say they represent the same thing, but for reefer rates, you're starting to build a little bit more model disagreement here. I think partially is due to a little bit of the dip we've seen. If you look at the very tail end of that blue line, which is the recent history, it took a little bit of a slide, and I think the models are wanting to nudge that back up, especially raycast, to where it expects it to be. So that's why you're seeing, and that's when we get to the end of that cone, you're looking at probably closer to 15 cents of disagreement, which is really interesting. And then we get to the spiciest of all, like a level 5 on a tie menu. We get to flatbed. So this is alarming. There's really no other way to slice and dice this. These flatbed rates have continued to fall. They're following a 2018 pattern, if you will. But the cost to operate is a lot higher than it was in 18. And to the extent that it's getting oversold, and when I say that, I mean rates are going below what our models would anticipate, is the degree to which the models are going to want to pull it back up, like bring it back to where it expects. So you can see raycast here really getting a sense of optimism that things are going to turn around heading into the fall. I don't necessarily share that optimism. I think housing's been really, really slow. Civic construction tends to slow down this time of year, especially in the northern latitudes. They want to wrap up the projects they have and not start anything new. So we're watching this very, very closely. It's evidenced in the load board activity that Dean shared. But I think flatbed of the three equipment types is the one to watch the closest at the moment. So I think that's the forecast wrap up.
Can I ask a question to Dean?
For this, we're all right here.
So cotton is getting devastated by drought.
Yep.
And so we're going to see reduction there. What do you think that'll do to the markets? Do you think that'll have a major effect, or is it pretty minor?
No, I think it's going to have a major effect in certain states. So California in particular has been devastated. We're seeing half the volume of rice planted. We're seeing impact on nearly every commodity that they produce. Remember, California produces well over half of our national volume each year. They're in the I don't know if it's the middle or the end of a 3-year drought. In fact, you could argue it's been a mega drought for decades. Okay. But the lack of water there is becoming a real issue. They have reduced a lot of their yields. They've tried to change their watering patterns. The end of the story is for the produce season. It was coming out of California, volumes were down about 30% compared to this time last year. Now, year-over-year comps are hard because last year was an abnormally high year and a longer season. This year, though, because of the extended drought and the lack of water lease rights from the federal government, meant farmers had less water this year than they ever had. Right. So they planted fewer acres and fallowed a lot more ground. And that's meant that produce volumes out of there are much lower. To answer your question, I think this is a long-term trend because there's no magic fix to the water problem in the West short of massive rainfall and all these desalination plants that should eventually pop up to help water things. So I think it'll change produce volumes out of the West Coast for a long time to come.
Yeah, interesting.
It is interesting. So we're going to move on to questions. Go ahead and drop your questions below. I have a couple here that I will get started with, but please drop your questions if you're on YouTube, LinkedIn, or Facebook, and we'll get those over to us. So Shanghai Trucking Corp has a question. What lanes should we run with dry vans from Harrisburg, PA to anywhere? What are the best places to go right now due to the market being low? That's a Dean question.
Yeah, that's yours, Dean.
Harrisburg is right in Dean's wheelhouse.
I've been to Hammer Lane every night going to Boston with retail freight because that's where this time of the year, that's where all of our retail freight comes, doesn't it, Chris? Everything we order online comes out of the Harrisburg, Allentown freight market. If you look at the interstate down there, it's nothing but warehouses. They've strategically aligned a lot of warehouses in that corridor to be next day delivery, even same day delivery to New York, Philadelphia, Baltimore, through New York all the way up to New England. So that's a market that I would focus on, is that overnight lane to New England in particular, because you can get up and back in a day without too much trouble.
Cool. So with the we've been hearing a lot about these East Coast port backlogs, right? The question came up: are some of these East Coast ports equipped to handle the retail surge in the fall?
They're not equipped to handle the massive buildup of empties. That's the problem. Well, it's not so much the throughput. They've got ship-to-shore cranes, they've got the berths, they've got the harbour depth. They can handle the volume. What's happening is because the vessels coming in are already 6 to 8 days late, they're turning and burning out of the port and not picking up the empties.
Oh.
Right? And because New York City is the first major port on the Baltic and Mediterranean transit line, they'll unload and then get going to Savannah, Norfolk, Miami, Jacksonville, Houston, and not come back. So all these empties are building up in New England, in particular New York. That's why they're trying to lease more land to store empties. So that's the real issue, is the empties. It's causing congestion because the chassis trailers are tied up under these containers longer. So it comes back to the shippers, Chris, where they are taking longer to unload these trailers, and it's causing this supply chain issue where they just can't move these empties quick enough. Unlike last year, where they couldn't move the empties fast enough back to their ports to reload, to come back to restock all of our warehouses.
They put on the rail then, all those empties?
So out of Chicago, they will rail them to Seattle, Prince Rupert, and Los Angeles. But they'll be 2 to 3 mile long trains of nothing but empties.
Yeah.
That's not a common thing. The East Coast ones, they will try and, I just noticed Philadelphia said we'll start to accept more empties. So what will happen is it'll be costly, but someone will send in a cleanup vessel. And they'll just send it in just to pick up all the empties. And they'll probably do a couple of sweeper ships to get rid of that backlog.
Makes sense.
That's super interesting. So kind of a broad question to Chris, since we have him here. What are you seeing? What's the view from the shipper market?
Happy days, right? It's a good time. So when you talk to shippers, they're starting to claw back some of the excesses or the increases in rates over the pandemic. But what's interesting is typically when a shipper does something like this, they do an RFP or a bid or an auction, whatever you want to call it, and they go to more carriers and therefore, find lower rates. This is just the opposite now. What we're seeing now, both anecdotally and in the data, is that they're starting to contract their carrier base. They're going deeper to their incumbents, and they're picking those incumbents that played well with them during the pandemic. Those that didn't raise their rates extensively, provide a good level of service. So they're trying to focus back in. And so what we're seeing shippers are doing, they're recovering from the pandemic, because another thing they did in the pandemic was increase the use of private and dedicated. And so private and dedicated increased by 39% in 2021, 39%, incredible amounts, which is really good for carriers because they make a lot of their money off the dedicated operations. I think that's going to lessen a little bit because they can find capacity another way. They don't need to keep it as utilized. If demand goes down, it's hard to keep a dedicated fleet rolling. So that might change a little bit too. So what we're seeing is, and this is showing up in the DAT rate view data and the load board data, is a decrease in the amount of spot going from a failure in a routing guide, right? So acceptance ratios are back pre-pandemic, 95%. They're up there. So not as much loads are going through the routing guide into spot, but we're seeing more spot direct used strategically by the shippers, where they set up APIs with a broker or an advanced or sophisticated carrier. And so we're seeing more spot volume going that way to the smaller carriers, but it's not as much as was going through failing from a routing guide during the pandemic. But overall, a lot of the trends that we saw mirror exactly what you were talking about, Dean. We found that the new rate differential, which is what we track in the FMIC consortium, is when a new rate comes in, what is the rate that it's replacing? And we're finding for both dry van and temp control, it's 5 to 6% gap. And so it's decreasing. So they're getting back and recovering some of that. We talked about the spot rate. How much has it dropped from the peak? Did you say about 60 cents?
It's about 30% year to date.
30%. What we're seeing now is the contract rate during that time kind of leveled out and now starting to decrease a little bit. It always lags. And so we're starting to see the cresting now. I don't think we're going to see it bottoming out anytime soon, like 2019 levels, because the cost basis has gone up. But we are seeing it normalize, if you will. So shippers are happy right now. The only ones that aren't, it's interesting you mentioned flatbed. We see flatbed rates still going up. New rate differentials are like 7% increase this past couple of weeks, and intermodal as well. Maybe it's just because of the congestion. But dry van and temp control are coming down. intermodal and flatbed, they're affected by different markets. So they're still tight from what we're seeing.
There's a drastic difference between contract flatbed freight and spot, right?
Absolutely.
A lot of that
Absolutely.
contract flatbed freight could be, I don't know, a big orange home improvement store getting lumber.
A lot of preloads.
Yeah.
Versus what we see a lot of in the spot market is energy, oil patch.
That's fair.
That's
hot
fair.
shots, that kind of stuff.
Yeah.
So,
Yeah.
if we went through like a Rip Van Winkle exercise where we fell asleep for the last 2.5 years and we woke up, this is the first time probably in that span that's felt kind of normal, right?
Yeah.
If you had no prior knowledge of what the freight markets were during the pandemic, right now is about as normal as it's felt, wouldn't you say?
Yeah, elevated level, still,
Right.
a little bit, but
Yeah.
it is.
But everything's elevated, right? I mean,
Yeah.
it costs more to run the truck.
Yeah.
I think the only thing that would probably cause you to raise an eyebrow would be fuel prices are just going to be monumentally higher than when you took that nap, right?
25 cents per mile higher to run a truck today than it is this time last year.
You're getting 25 to 30 cents more on the top line.
Well, you still, so the big change would be that your break-even costs of $2 a mile are in the ballpark of where national average line haul rates are, excluding fuel.
Yeah.
So it's still not, the calamity that some would make out that it is. Carriers are still doing quite okay.
Yeah, but the only thing that's deflationary right now is truckload. It is down. It is going down. But then, for the shipper, they're not feeling that deflation because fuel is up.
Right.
And so they're paying less in line haul, they're paying more in the fuel surcharge. So it's kind of a wash, and it's still not recovering. It's better than it was. Let's put it that way.
The fuel surcharge is down to 61 cents today on RateView, and I think that's roughly double where it was this time a year ago for the shippers.
Yeah, but it's down from 84 cents. Is what
So the peak on June 20 was 81 cents.
81 cents?
Sorry, 581 per gallon. So it's down to 4.90 now. So
Yeah, right.
90 cents. Yeah, 90 cents.
Well, it's good. I mean, I think it's good that things are normalizing. Especially, we've seen in our data that it's taken some pressure off the small carrier. The small carrier that's not on a fuel recapture program, paying a dollar less per gallon is necessarily a good thing,
right,
for diesel. So that's good, and the rates haven't necessarily come down anymore. So over the real short term, it's been a nice little upside for carriers over the last 2 months.
Yeah, one of the things that I've noticed is that if you go back and look at 2019, in June of 2019, we had a record number of bankruptcies reported throughout the media, and the number of trucks at the two big auction houses was about, I'm going to say 1,200 trucks in the month of June. So I watched very closely the JD Power auction inventory report. The month before, it was up a little bit to about, I'm going to say 300. It's down to about 200 trucks in July. So 200 trucks at auction is a long way south of 1,200 in June of 2019.
Aren't you surprised?
No.
I would think that number would go up.
No, I'm not surprised because carriers had one of their best years they've ever
Yeah,
had
but
last year.
there are a lot of carriers that bought in at the end of the.
I think they've already gone. No, so my
okay.
point is that I think the carriers that bled off the market was in the April-May period. Since then, I'm actually seeing the market come back to more normal.
I see. Okay.
We added 27,000 more trucks and 9,000 new companies in the month of July with DAT authorizations. So there's more trucks coming back into the market compared to the prior months, which again defies logic because you would have thought the market was, bleeding capacity. I think we've turned the corner.
That's interesting because I was just checking the data earlier this morning, and it was the week of 11 April was when spot crossed contract in the FMIC data.
Yeah.
So it's 4 months.
Yeah.
We usually don't see trends where the spots below contract that long.
From the
4
shipper
months.
perspective.
From the shipper's
for everyone
perspective.
watching,
Yeah.
Chris is talking about the shipper perspective.
Right.
I mean, I think there's benefits. I think you need to kind of look holistically at all the data you have available, right? Because if you only look at high frequency data, it causes you to have these massive overreactions to very short term blink.
Right.
I think it's important to round out how you're looking at the market contextually with long term trends blended with what you're seeing cutting edge right now.
And it's coming back to your point, Ken. It's coming back to it's regressing to the mean. Right. And so we'll always see the cycles up and down. And now we're on about a 5 to 6% compounded annual growth rate.
Yeah.
Prior to pre-pandemic, it was probably 3 to 4.
If truck show season and attendance and shiny stainless steel trucks is anything to go by, we are not in a recession. The trucking economy is doing exceptionally well compared to previous years. So.
What about I've read some, and I'm curious your thought on this, Dean, the hollowing out. Because the mega carriers will do well because they have economies of scale in how they buy things, insurance, everything. The smaller guys are more nimble. The 50 to 100? It seems like they decrease the number of power units actually decreased for some carriers in that size. Do you think that's going to
I think could have been,
bifurcate the market?
I think so, because I think it has a lot to do with the driver supply.
Right.
I think the pandemic really drove a wedge in that particular part of the market. You saw a big increase in, I think the larger fleets have been able to, since about September 2020, start to attract more drivers through more pay increases. That's attracted more new entrants into the market. There's certainly been a consolidation of those fleets that where maybe, guy that was leased on maybe had 30 or 40 trucks that was leased onto a large fleet.
Okay.
I think they really struggled to find new drivers in that period.
Interesting.
One question, and then we'll kind of get to the wrap up here. Avi Roy asks, has there been any laws that went into effect to make ports more efficient? The last I recall was the Ocean Reform Act, but now West Coast ports are forcing shippers to go to the East Coast.
Well, as a shipper, it's always been a good strategy to have both ports, both coasts for your shipping strategy, to include the Gulf Coast. So they've always been doing that. It's a better thing for them to be able to do that than just be waiting on the West Coast.
Right.
The problem is a lot of the inland transportation is not set up as much for the volumes that are
That's
going.
what I worry about. I mean, drayage coming from Savannah, that's not a day turn. It's 250 miles roughly, right, to the Atlanta warehousing district where you're going to take that in and then shoot it out.
Right.
It doesn't have the retail kind of apparatus that Southern California has to support.
Well,
So
but then again, it's not going far, right? Because from
True.
LA, it's going all across the country to the East Coast.
but I mean, if you're listening, that could be a boon for spot freight in the. I mean, that's why. I mean,
That's
we're
good
talking
to
about ocean. I mean, that's where my ears would be perking up if I were still. I mean, I'd be probably thinking about my pricing strategy in Georgia, North Florida, South Carolina,
coming in from those ports.
because I'm probably going to be getting excess retail volume that I wouldn't. I might only see in Southern California, and a lot of those shippers might not have contract rates for, their big retail carriers to push that freight up, because it's mainly going to go Chicago, Harrisburg, could go as far west as Dallas. So I'd be thinking about those lanes, and you might have a little bit more pricing power than normal because there's congestion, there's a backlog. That's why we're talking about it, quite frankly.
Right.
We're going to see more volumes come into Houston. That'll be, their volumes are up 24% year over year. You're going to see more volume coming to Jacksonville. There's already more volume coming into Charleston. So some of these smaller freight markets on the truckload side are going to see more year over year volume come in, and they're going to grow.
Do you think that'll stick?
I think so.
Congestion it works its way out in the ports in LA. Do you think shippers will balance to both coasts?
I think, certainly the ports hope so, because of the amount of money they've invested in infrastructure. But that'll come back to contract rates on the intermodal side off the West Coast versus truckload capacity on the East Coast.
Be a nice time to have some shares in the Panama Canal.
Well,
what about exports? Do we see any change in exports?
Yeah,
are they also shifting to more the East Coast and the West Coast?
No, they're down on both coasts equally. All right, it's about a 50-50 split. I pulled the data this morning on exports. Total exports for June, because in our peers' data we've only got June exports ratified through the Customs and Border Patrol bills of lading that we look at. Total exports are down 8.7% month over month. Year-to-date export volumes down, 8.7% year over year.
Okay.
So volumes have been declining since the pandemic started, largely because of this empty container phenomenon, where shippers were reluctant to send empty containers inland to backload.
Oh, I see.
What they made on the backload and losing 2 weeks was far less valuable than sending the empty straight back to Asia to reload to come back. So that's why exports suffered a lot, was because of this lack of available equipment inland. So this shift, to answer the previous question a little bit more, this previous shift, July's data on imports was the 9th highest on record at roughly 2.2 million TEU, 9th highest on record, but it was the 14th straight month where year over year comps favoured the East Coast versus the West Coast.
Percentage?
Yeah. So
not total, percent change?
Yeah, percent change. So if you look at the actual month over month, year over year change for East Coast, they're up 8.7% year over year. West Coast is down 4.3%. So there is a shift going on to the East Coast.
And you think it'll stick?
I think it'll stick. Yeah, I think people will reroute. Because remember, the labour agreement on the West Coast is run into a roadblock, right? Especially in Seattle.
They don't have one right now.
Yeah, right. So I think it's got some problems. So, and that's why shippers rerouted their vessels, obviously because of this concern. I think it'll stick, Chris. I think people will be reluctant to go back to the service failures they saw, in the last year.
That guy with the high frequency data said we were going off an import cliff.
Yeah.
I don't know what happened.
Yeah.
It was like fiscal cliff. Remember fiscal cliff?
I think with the peak though, I think we'll see volume start to slow down.
Well, of course, yeah.
Lars Jensen did a great LinkedIn post yesterday from, am I going to get this right? Vespucci Marine. I think I've got it wrong, but anyway, Lars Jensen on LinkedIn. He said it'll
Great follow, by the way.
Yeah, he said it'll be mid-2023 before supply chains get back to normal on the import side.
That makes sense.
Yeah.
One other comment before we move to plugs. Whitney Fowler says, I feel like I can calm down a bit, liking the trends we were seeing. You should always remain calm, no matter what's happening. You just stay chill. It's
Everything's
great.
fine.
It's great. We're all living in, it's 3 years of a this is fine meme. It'll be all fine.
Yeah.
All right, Dean, plugs.
Yeah, I'll be on Sales Chatter in the morning at 9 a.m. Eastern with Dan Deegan and DJ Flores. It's day-to-day Wednesday. Stephen Pettit's going to be on Landline now tomorrow night at 7 p.m. Eastern on Road Dog Radio, Sirius XM, Channel 146. And I'll be on with Jimmy Mack on Thursday morning at 8 a.m. Talking about trucking on Road Dog Radio. The Thursday next, sorry, I think it's this Thursday, you've got Freight Vine out.
That's right. 2 days from now, it's an edition with Todd Spencer, the CEO of OIDA, or the
IDA.
Yeah,
Yep.
OIDA, depending on how you pronounce it.
Yep.
Yeah, so that's a great one. He tells some great stories about trucking in the 70s.
Yep.
We talk about CB radios and breaker and all that good stuff.
10-4, good buddy. And of course, don't forget DAT's DATCon is on October 5 to 7 in Austin, Texas.
That's right. So I have a couple here. We recently launched our DAT One app. If you haven't checked that out as a carrier, I could not possibly recommend it more. Industry-leading load board, broker credit scores and reviews, and allows truckers to get paid in as little as 24 hours. Really, really good. Super proud of what that team's been able to accomplish, and it's been getting really, really great feedback. So I recommend you check that out. And then as Dean mentioned, DATCon, so that's October 5th to 7th in Austin. We'll all be there. Tons of really great sessions. The Blonde Bomber is our keynote. That's Mr. Terry Bradshaw. Growing up a lifelong Steeler fan, I'm excited about that.
The Blonde Bomber?
The Blonde Bomber, yeah.
I've never heard that before.
Well, growing up in Pittsburgh, you would have.
Yeah.
So, I mean, a lot of my friends are jealous that we get Terry Bradshaw at our event.
Awesome.
So that'll be great. Like I said, it's the 5th through the 7th. We have a whole day shipper summit, which is the first day. And then it blends into the blended event Thursday and Friday of that week. Austin's a great town if you've never been. Awesome barbecue. Not South by Southwest. Austin City Limits kicks off that weekend.
Yeah.
We really would love for you to join us and see us in person. So I recommend you check that out. With that,
Ken will buy you a drink at the Continental Club.
Oh, I don't know what that is, but you went to UT, right?
I got my master's at UT. Yeah. Got married in Austin. Great town.
It is a great town. Lambert's and what's the guy? The famous guy with the huge line. That doesn't matter. You'll trip over great barbecue spots down there. Franklin Barbecue, that's the one. It's a little bit of a drive outside of town, but I could not recommend it more. Bring a cooler, bring some cold ones. So with that, I'll sign us off. Thanks for joining us live from Denver, and we'll see you next week. Bye, everyone.
Bye-bye.
See you.